What if I told you there may be a way to decide when you pay taxes on your retirement savings instead of waiting for the IRS to decide for you? Think about that for a second. For most people, taxes aren't optional, but when you pay them, it just might be. If you've been following this series, we've already talked about why taxes matter in retirement. We talked about why many people believe tax rates could be higher in the future. And in our last episode, we talked about why you may not actually own every dollar setting inside of your traditional 401k or IRA. Today, we're going to talk about one of the most powerful retirement tax planning strategies available. It's called a Roth conversion. And despite what you've probably heard, it's actually much simpler than most people think. So, what exactly is a Roth conversion? Here's what it is. A Roth conversion is moving money from a traditional IRA into a Roth IRA. That's it. You're moving money from one retirement account into another. But understanding why someone would do that requires understanding the difference between those two accounts. Let's start with a traditional IRA. When you contribute to a traditional IRA, or when you contribute to a traditional 401k, you usually receive a tax deduction. You don't pay taxes on that money today. Instead, the government allows you to postpone those taxes until later. Your investments grow tax deferred. Then when you begin taking withdrawals in retirement, those withdrawals are typically taxed as ordinary income under the current law. Now let's compare that to a Roth IRA. With a Roth IRA, you don't receive a tax deduction when the money goes in. Instead, you pay taxes first. Once the money is inside the Roth, it has the opportunity to grow. And under current law, qualified withdrawals in retirement can be tax-free. That's the biggest difference. One account gives you a tax break today. The other may provide tax-free income later. Neither account is automatically better than the other. They simply work differently. Now, here's where the Roth conversion comes in. When you move money from a traditional IRA into a Roth IRA, the amount you convert is treated as taxable income for that year. In other words, you're choosing to pay taxes now instead of later. Now, I know exactly what some of you are thinking. Gary, why in the world would I choose to pay taxes now? And that's a great question. And the answer is, it depends. Remember what we talked about earlier in the series? If you believe tax rates could be higher in the future, you may prefer paying taxes while the rates are lower. If you believe your income could increase later in retirement, that might also influence your decision. On the other hand, if you believe you'll be in a much lower tax bracket later, a Roth conversion may not make sense. That's why this is never a one-size-fits-all recommendation. I like to explain it in this way. Imagine you borrowed money from a friend. Your friend tells you can pay him back whenever you want. You could wait, or if you thought the amount you owed was only going to get larger over time, you might decide to pay your friend back today. That's similar to a Roth conversion. You're deciding when to settle up with the IRS, today or sometime later. That decision isn't about avoiding taxes. It's about choosing when to pay them. Now, let me clear up one other misconception. A Roth conversion is not an investment. People sometimes hear the phrase and assume it's some special financial product. It's not. You're not buying a new investment. You're not changing the performance of your portfolio. You're simply changing the type of account that holds your retirement savings. Think of it this way. If you move money from your checking account into your savings account, the money's still yours. It's simply sitting in a different account. A Roth conversion works in much the same way. The investments themselves may stay exactly the same. The account they're held in actually changes. Here's another misconception I hear all the time. People think if I do a Roth conversion, I have to convert my entire IRA, and that's simply not true. In fact, many Roth conversion strategies involve converting smaller amounts over several years. Why? Because it may allow you to stay within a certain tax bracket. It may help reduce future required minimum distributions. It may create greater tax flexibility later in retirement, and for some people, it may fit better into their long-term estate planning goals. There's no rule that says you have to convert everything all at once. In fact, that's often not how thoughtful planning is done. We'll spend our entire next episode talking about that strategy because it's one of the biggest misconceptions surrounding Roth conversions. The most important thing I want you to remember today is this. A Roth conversion isn't automatically good, and it isn't automatically bad. It's simply a planning tool, just like Social Security claiming strategies, investment allocations, or estate planning. It's one of the many tools available to help build a retirement plan. Whether it makes sense for you depends on your age, your income, your tax bracket, your retirement goals, and your overall financial picture. That's why every Roth conversion decision should begin with an analysis, not an assumption. If you found today's video helpful, please take a second to like this video and subscribe to our channel. Every week, we're releasing another episode in our retirement tax series to help you better understand retirement planning and make more informed financial decisions. And if you click the notification bell, you'll be notified every time we release a new episode. Now, next week, we're going to tackle one of the biggest myths surrounding Roth conversions. Do you have to convert your entire IRA all at once? The answer is no. And understanding why could completely change the way you think about retirement tax planning. Thank you so much for watching, and I'll see you on the next video.